In our last lesson, we learned what a stock market is. Today, we're going to look at the historical record. We'll see that you can make a lot of money investing in stocks. We'll also see that there's no free lunch. If you want to try to make a lot of money, then you have to take some risks too. We also have to realize that investment advisors always include a disclaimer. I'm sure you've heard it before. Past performance is not necessarily indicative of future performance. We'll use some specific numbers to illustrate points, but the idea today is not to worry too much about those specific numbers. We want to get the big picture. What does the historical record say? Let's begin with the good news. It says that you can make a lot of money investing in stocks. If you had invested just $1 at the beginning of 1926 and reinvested all payouts such as dividends over the next 87 years, then you'd have done rather well. By the year 2013, a $1 investment in a broad portfolio of stocks would have been worth $2,843. Large company stocks wouldn't have done quite so well, but your $1 investment would still have turned into $2,103. The same investment in small stocks would have done remarkably better. Your $1 investment at the beginning of 1926 would have been worth $801,997. You'd have beaten the stuffing out of inflation too. To maintain the buying power of the $1 you invested, you'd need just $12.83 in the year 2013. You would have earned more than 222 times that by investing in a broad portfolio of stocks. The main story that you can make a lot of money investing in stocks doesn't change much if we look at different selections of stocks according to characteristics like size. Sure, small stocks beat large stocks over the period from 1926 to 2012, but you would have made a lot of money in either asset class. The main story doesn't change much if we spread our investment equally among all companies, or if we had invested more in big companies than we did in small ones. You'll find differences by industry, of course, especially for relatively short periods. Sometimes financial stocks will do better than energy stocks, which might in turn beat transportation stocks. And sometimes transportation stocks will do better than financial stocks and energy stocks. But for the most part, the historical record seems to say that you just need to get into the market and stay there for a long time. I'll bet you know what's coming next, don't you? I'm going to change just one single word. I'm going to change make to lose. You might find that hard to believe by looking at stock returns over very long periods, and in some sense, you're right. The historical record does suggest that you can recover any losses in stocks if you stay in the market long enough. You'd have gotten absolutely hammered if you had needed the money from your 1928 investment at the beginning of 1933. You would have lost about 2/3 of your initial stake. True, your investment would have recovered almost all of the losses by 1936 or so, but you wouldn't have gotten back to the break-even point permanently until 1943. That's about 15 years. That's 15 years before you do much better than just break even, and even at that, we've ignored inflation. For most people, 15 years is a long time to have your portfolio be underwater. Would you have had the stomach to tough it out for that long, or would you have thrown up your hands and gotten out of the market somewhere along the way? What's more, I'm going to say the same thing that I said about the story not changing much if we look at different selections of stocks according to characteristics like size. You would have lost less in big companies, and you would have recovered a little sooner too. But it would still have been a rough ride for 10 years or so. And just like when we looked at the happier side of the story, the main point that you can lose a lot of money investing in stocks isn't going to change if you look at different industries, especially for relative